Wouldn't it be great if you could ask Warren Buffett himself how you should invest your money? And if you could ask him, what would Mr. Buffett tell you to do in terms of investing in stocks versus bonds? And would he actually suggest a specific mutual fund? And if so, which one would he recommend? Believe it or not, we're going to answer these questions and more on this, the 41st episode of the DoughRoller podcast.
Welcome to the DoughRoller podcast, where the best thing money can buy is financial freedom. We help you make more, spend less, and invest the rest. And now your host, Rob Berger.
Whether you're just starting out, buried under a mountain of debt, or well on your way to financial freedom, this is the podcast to help you take your finances to the next level. Hey everybody, welcome to the 41st episode of the DoughRoller podcast, and I've got one today that I think you'll really enjoy. I hope you do. It, I think, is a very important topic, and it's almost as if we have Warren Buffett himself on the show. I wish that were true, but I read an article today in which he gives us some pretty clear insight into how he thinks most folks should invest their money. And I've read, articles in the past where he's talked about, low-cost mutual funds as the best way to go. Low-cost index funds is the best way to go for most investors. And that's, of course, helpful, but, it wasn't real specific. Today, though, I've got something that I read that's far more specific. It actually gets into the allocation he's going to use in a specific circumstance, I'll get into it, between stocks and bonds, and even a specific mutual fund that he would use to invest in the stock portion of his portfolio, believe it or not. And so that's what we're going to tackle. I think it'll give us some real good insight into how Warren Buffett would invest, or how he thinks, regular folk like you and me should invest our money. And I think it's very insightful, and I hope you'll find it helpful. The other part of that is how investing in real estate it gives us some lessons in how we should invest in the stock market. You might hear that and think, well, wait a minute, those are two totally different things. Investing in real estate on the one hand versus buying stocks. How they're both investments, sure, but they feel totally different, and yet they shouldn't. They should be for us if we're investing in stocks the right way. In fact, I shouldn't even say that. We're not investing in stocks. We're not investing in the stock market. We're investing in real live businesses. And if you listen to the 31-Day Money Challenge, I had an episode talking about investing like a business owner and how important that is. And really, when we look at real estate investing, we can learn some lessons about how to invest in the stock market. And that came out in an article that I'm going to talk about today involving Warren Buffett and how he invests in real estate and how he looks at investing. And so that's going to be the topic for today. Before we get to it, though, there's a comment that a reader left on the blog, and it's very relevant to the topic today. And so I want to talk about that first. It was left by a guy. I'm going to guess this is not his real name, Joe Dough, D-O-U-G-H. I can't fault a guy for putting dough in his name. It is DoughRoller after all, right? It was a rather long email or comment, so I'm not going to read the whole thing, but I want to read sort of the key part of it. And it had to do with investing for retirement. It was a comment in response to an article I'd written actually some time ago about Social Security being worth $225,000 for a typical retiree, and what really was a present value calculation of future Social Security payments based on a certain discount rate and life expectancy. And I thought it was an interesting analysis, so I had written about it some time ago, and I had mentioned it in my newsletter this past week. And so Joe Doe left a comment about it, and let me read part of it. I'll read it in a couple of chunks. Let's start with the first one. He says, "I will tell you that I tried my best to manage my own account with a large brokerage, and in October of 2008, when I realized that this was a real crash happening, I moved everything into a bond fund. that was available. So let's stop there. As you may recall, 2008 and into 2009 was a tough year for stocks. They went down significantly, and like so many other folks, this reader sold his stock investments. We talk about this time and time again, how you need an asset allocation plan, and you need to stick with it, whether the market's going down and you're scared of stocks, or whether it's going up and you're kicking yourself because you don't have more in stocks. Either way, it's important to come up with a thoughtful asset allocation plan and stick with it. And in this case, Joe was unable to do that. And he sold his stocks and moved them into bonds in October of 2008. Now, what's he think about that now? Well, I'll keep reading. My big mistake was not jumping back into a diversified portfolio once again after the dust settled at the bottom and then riding the wave back to the top again. Well, let me stop there. I'm not so sure that was his big mistake. I would argue that his big mistake was selling in the first place. Now, maybe he'll disagree with me, but I think his big mistake was not sticking to an asset allocation plan to begin with. And I kind of cringe, I don't mean to pick on Joe. I mean, we're all trying, we're all learning as we go, but this sort of riding the wave back to the top again, that to me, it's just, maybe it's just the wording or semantics, but that to me seems like someone investing in the stock market rather than investing in a business. And I still firmly believe whether you're invested in a mutual fund that owns 500 shares in over 500 companies, or whether you're investing in individual stocks, we're investing in businesses. Sometimes it feels like a game, right? You can track the price of a stock minute by minute when the market's open, and you can log into your account, and with the click of a mouse, you can buy, you can sell. There is sort of a game sense to it, and it's the kind of thing I think we need to resist as best we can, because we really, for long-term investors, you will do best, I think, if you view this as investing in businesses. And as I mentioned earlier, that's something I covered in the 31-Day Money Challenge, and I think it's worth listening to that podcast if you haven't. It was day 16. Of the 31-Day Money Challenge, why you should invest like a business owner. And you'll find that podcast if you go to DoughRoller.net/podcast 23. If you haven't listened to it, I highly encourage you to take a listen. I think it's to me, it's really the sort of fundamental concept of what it means to invest at all. So anyway, going back to this comment, He then goes on to say, everyone I know that stayed in, I think this is so important, everyone I know that stayed in during the crash and up to now has made a recovery and then some. And if we go back and look at whatever period of time you want going back in history in the stock market, that's always the case. Even if you go back to the Great Depression where the stock market just got pummeled, and it got pummeled for a very long period of time, the folks that stayed in it ended up okay. Now, you have to think long term. You're looking 10, 15 years, 20 years. But that's really the point of these sorts of investments. These are long-term investments for our retirement way down the road. And I think this is, what Joe talks about here is a real good lesson. Those that stayed in during the crash, made a recovery and then some. And that certainly was my experience. I didn't sell any stocks or stock funds in the 2008, 2009 time period. I stuck with my asset allocation plan, kept investing, and everything worked out fine. Again, we could have another crash, right? Obviously, if we're investing for any period of time, we will experience significant market downturns. And I think the key is to stick to your asset allocation plan during those times. I will say, and just finishing off Joe's comment, he does say, I feel I lost out from an accumulation since that time, but seeing my original funds in the account at this time, just before retirement, and estimating my pending Social Security payments coming, I'm not in bad shape at all. And that's certainly good to hear. It sounds like he did a great job preparing for his retirement. And, it underscores something. So Joe, looking back, says, I made a mistake here, but, I'm still okay. And I can certainly look back at many mistakes that I've made in investing, to be sure. And, we're all going to make mistakes. And I think the key is to learn from them, to keep moving forward. I think if we do that in the long term, we'll be fine. We're not going to be perfect. Heck, Warren Buffett will talk about mistakes he's made. So, we're all going to make mistakes. That's just part of life. And I guess that gets us to Warren Buffett. So what I read, I'm going to leave a link in the show notes. You'll find those at DoughRoller.net/podcast 41. That's podcast followed by the number 41. It was an article, I actually saw it on CNN. I think it's from Fortune magazine. And it was an excerpt of the upcoming Berkshire Hathaway letter that Warren Buffett writes every year. It's absolutely worth reading cover to cover. If I could only read one thing a year about investing, it would be his letter to Berkshire shareholders. And by the way, I think I've mentioned, I went last year to the shareholder meeting. I dragged my wife and daughter along with me, and believe it or not, they had a blast, even though they're not really into this investing stuff. This year, I'm taking our son. So, shoot me an email. If anyone else listening is going to be at the Berkshire Hathaway meeting in early May, let me know. It'd be great to meet folks. So it's a lot of fun if you're a shareholder. And in any event, so an excerpt of the letter was released, and it was interesting. The first thing Warren Buffett talked about was investments that he made in real estate. And it reminded me, although on a much, much smaller scale, of investments that I made in real estate. And there's a point that he makes. So I want to share a story with you of my own experience, and then relate to you the very point that Warren Buffett makes about investing in real estate and what it can teach us or should teach us about investing in businesses in the stock market. And so I want to do that first. And then we're going to cover his asset allocation. Believe it or not, he talks about it, how he would invest money, how he's going to invest money. And I'll explain that in just a minute. So let's first talk about real estate investing. Let me give you a short story. Back in 2005, my best friend from high school asked me if I wanted to invest in real estate. He lives in Central Ohio, where we grew up, went to high school together. His father's in the business. He's invested in real estate for, 4 decades or so. And so, I was very interested. I was scared to death. Will we get tenants? How hard will it be to fix up property? What if we can't rent it? What if they don't pay? I just had all these fears, but something compelled me to do it. And so in 2005, we put a couple of bids in on 2 HUD foreclosures. And he said, don't worry about 2. We'll be lucky to get 1. But we're definitely not going to get them both, because I was scared to death we'd get them both, and then financing and how are we going to swing this? Well, of course we got them both. HUD foreclosures are sold on an online auction basis, so you put a bid in online. We did that. We won them both. So here we are. I start with nothing. Now we've got 2 single-family homes in Central Ohio that require some substantial rehab, repairs, and so I was scared to death. The long story on that is it's worked out fine, and here was the real key to that, and something that Warren Buffett describes in his own real estate investing in this article. When we were evaluating these investments, we were not trying to predict what the house that we were buying would be worth in a year or 3 years or 5 years or 10 years. We were looking at what kind of income these properties would generate for us. So we were making an estimate of what we thought the reasonable market rent would be. And then we were backing out of that costs, the taxes and insurance and repairs. We would make an allowance for vacancy, because sometimes, folks would move out and maybe it's a month or 2 before we can get a new tenant in. And we would subtract all these expenses and look at what's left and look at our cash flow. And that's how we based what properties we'd bid on and how much we'd pay for them. Of course, we had to make an estimate of what we thought it would cost to rehab the properties. But the point is, we were looking at the income that this asset could generate. And if it could generate what we thought was a reasonable return, we would put a bid in on the house. And whether it went up or down in value in the next few years was almost, it really wasn't part of our analysis. In the long term, we certainly expect the value of the real estate to go up. I generally expect it to go up over the long term by the rate of inflation, roughly. But that wasn't really part of our what we were factoring in. We were looking at whether we could generate a reasonable income from the properties. We thought we could, and as it turned out, we could. Our estimates were fairly reasonable and came in line with the results that we achieved. And of course, if you recall history, so this was in 2005, we had a real estate crash at the end of 2007. And while it didn't hit Central Ohio as badly as it did, say, Arizona or Las Vegas or Miami, it certainly hurt. I mean, the market certainly went down in Ohio like it did everywhere. And the properties went down in value significantly. But you know what? It didn't affect us. The rents were still strong. In fact, the rents were maybe as strong as ever. And the tenants were still paying rent. We didn't have any evictions. We had very little vacancy. And that's true even to today. And so the rent checks kept coming in, and we kept making a good cash flow. We were paying down the mortgages that we had on the property. And, you can imagine if this were like the stock market. What's the difference? Well, for starters, you can't just click the mouse and sell your real estate, online. It's very involved and has a lot of transaction fees, and you don't have people offering to buy your house every minute of every day when the market is open, like you do stocks and mutual funds, right? It's not as if the folks came to the house every day and shouted out some price they're willing to pay for your home, and so it has a different feel to it, very different feel than the stock market. But should it? And this was the point that Warren Buffett made in the article. Again, I've linked to it in the show notes. He said, folks ought to look at investing in businesses, public companies, much like you might look at investing in real estate. What kind of income, what kind of earnings can be generated from this investment? Is it a reasonable return? And if it is, and you invest in it, don't worry that the market crashes, right? I mean, markets are going to go up in unrealistic terms. They're going to go down. There's going to be periods of greed, and there's going to be periods of fear. And we ought not let that drive our investing decisions, at least when you think about it from the perspective of income. Now, certainly the price matters, right? In 2008, Warren Buffett looked at stocks and said, hey, they're on sale. They've gone down in price. I can get some good deals, right? He's still, though, evaluating the intrinsic value of the actual company and the income that he thinks that company will generate over the foreseeable future, the dividends that it will pay, the growth in earnings that it will achieve. In some sense, no different than you'd evaluate real estate. What kind of income will this property generate? What will be my expenses? What will be my profit? Do I see any sort of growth there? It's the same thing. But mind you, it's not looking at, what will the market pay for this stock a year from now? That's not what he's looking at. And I think it's a very good lesson for us as we evaluate individual stocks, or even if we invest in mutual funds, low-cost index funds, which is primarily what I invest in. If the market were to lose 20 or 30% over the next month, how would you react? If I think for Warren Buffett, he would see stocks as perhaps going on sale. He certainly wouldn't sell out of fear. And that was really, I think, the point of his article. It was to try to divorce what's going on in the market every minute of every day when the market's open versus the real value of the underlying company. And that's what Warren Buffett is focused on. I think that's what we should be focused on. And I really encourage you to read that article. I mean, of course, Warren Buffett he just has a way with words. He describes it infinitely better than I can. But I think it's well worth your time in reading it. In my case, the real estate investing has done just fine. We've continued to generate income each year that's covered our expenses and then some. Our cash flow has grown over the years as we've been able to increase slowly our rents. And now, slowly, the actual market value of the properties is rising. That's actually not my most important concern because we don't plan to sell. But it shows you that with the income generating potential, it weathers the bad storms in terms of the market price, in this case of real estate, and over time it eventually recovers. Now, all of that gets me back to really the real focus of today's podcast, and that is how does Warren Buffett suggest that most folks invest their money? And I want to read to you what was in the article, a short section of it. Here's what he says. He says, "My money, I should add, is where my mouth is. What I advise here is essentially identical to certain instructions I've laid out in my will. One bequest provides that cash will be delivered to a trustee for my wife's benefit." He goes on to say that his Berkshire stock actually goes to charitable organizations. Then he says, and this is the key, "My advice to the trustee could not be more simple. Put 10% of the cash in short-term government bonds and 90% in a very low-cost S&P 500 index fund." And then in parentheses, he says, "I suggest Vanguard's VFINX, which is their S&P 500 index fund." He then goes on, "I believe the trust's long-term results from this policy will be superior to those attained by most investors, whether pension funds, institutions, or individuals who employ high-fee managers." So here we have arguably the greatest investor, certainly of our time, someone who can evaluate the intrinsic value of a company as well or better than anybody, recommending to trustees who are going to handle money that he leaves to his wife, recommending a low-cost index fund approach to investing. And as I thought through what he had to say, I have sort of, I guess, four high-level takeaways. The first is this. Warren Buffett is bullish on stocks. I mean, think about this. His stock-to-bond allocation is 90% stock, 10% bonds. He believes that over the long term, stocks will have a greater return than bonds. Now, certainly, if we look back in history, that's absolutely been the case. And Warren Buffett believes that's going to continue. Now, I should say that I don't think this means that everyone should run off and put 90% in stocks and 10% bonds, right? One of the things I stressed in the 31-Day Money Challenge is we need to think for ourselves and we need to evaluate what's best for us. I think that's true even when we're listening to Warren Buffett. You know, I don't know how much money he's leaving his wife. I'm going to guess, though, that it's probably more than you and I have to invest. And it may be perfectly sensible to put that money in 90% stocks and 10% bonds. For all we know, she can live comfortably just off the dividends that are generated by an S&P 500 index fund. I don't think that means that all of us should run out and have 90% in stocks and 10% in bonds. But it does tell me that his view is a portfolio should certainly be heavily weighted in favor of stocks. Again, that might be 80-20 for you. I think it might be 70-30 for you. Part of it's going to depend on when you're retiring and your investing horizon. My guess is that this is set up to be a very, very long-term investment. But putting aside the exact allocation, it's clear that Warren Buffett believes in the future returns of stocks over bonds. I think that's point one. Point two is he avoids the interest rate risk on bonds. And let me explain what I mean. What is interest rate risk? From the sound of it, you might think it means that whoever has borrowed the money fails to pay the interest payments. That's not it. That's actually credit risk or risk of default. Interest rate risk is this. It's that you imagine you invest in a 30-year bond that pays 3%, and then next year interest rates go up to 5%. Well, you're kicking yourself. You're like, man, I just locked my money away for 30 years at 3%. If I just waited a little bit longer, I could have earned 5%. Well, that increase in interest rates actually lowers the value of your bond, right? You can imagine trying to sell it when the prevailing rates are at 5%. And people would, why should I buy your bond at 3%? I can go get a brand new one at 5%. And so to sell it, you'd actually have to discount the face value of the bond to account for that difference. So the interest rate risk is that interest rates will rise. And when that happens, it lowers the value of existing bonds. So you say, well, all right, how do you deal with that? Well, you invest in short-term bonds, right? The longer the term of the bond, the more negative impact rising rates has. So you can imagine a 30-year bond, if rates went up a lot, man, that could kill you. But if your bond was short-term, say it was only a month or a year, well, it would hurt you, but not as much. And so I noticed that the 10% that Warren Buffett's going to put in bonds, he's going to put in short-term government bonds. So he's avoiding the interest rate risk. It's probably in part a reflection of the fact that we are at historic low interest rates right now, and so we don't know when they're going to go up, but it's a good bet that they will. The other thing I'd say about this second point is that, it's interesting that he's not 100% in stocks. Why is that? Why does he have 10% in bonds? He doesn't say, but I suspect it could be a couple of reasons. I mean, maybe some of the bond investing is going to fund some of the cash withdrawals from this account. I don't know. But I also suspect that there's a view that a little bit in bonds lessens the volatility of the overall return. I always cringe when folks are 100% stocks, and I know a number of people are. I've interviewed people on this show that are 100% stocks. If you can stick with that plan, I guess it's not the worst decision, but I think for most people, 100% stocks is probably just too much. That's my view. In any event, Mr. Buffett's going to be 90% stocks, 10% bonds. So the first one, he's very bullish on stocks. The second point is he does have bonds, and they're short-term bonds. That helps lessen the interest rate risk. The third thing I think we can learn from his approach is that he's very bullish on the future of the United States. Notice that his stocks are in an S&P 500 index fund. Now, those are all U.S. companies. Now, one could say, well, why do you do that? I mean, why not have some foreign fund? And, of course, he doesn't say. I think it's perhaps for a couple of reasons. One is, again, he's very bullish on the future of the United States. I mean, it's been clear from a number of things that I've read that he believes in the ingenuity and the hard work of the American people, and he believes that we will continue to prosper in this country for a very long time. I suspect there might be another reason, too, and that is that even though the S&P 500 index fund, like the one he mentions, the Vanguard fund, is considered U.S. stocks, it has tremendous exposure worldwide. I mean, you think about the companies that make up the S&P 500. Apple, for example. I mean, its sales overseas are extraordinary, or McDonald's, or Coca-Cola. I mean, these sort of household names, big brands, have huge operations overseas. Many of them, in fact, their sales overseas exceed their sales in the United States. So although it's categorized as a U.S. fund, it certainly has exposure to really worldwide operations, if you will. And so in some ways with an S&P 500 index fund, you are getting foreign exposure. Again, I don't know if that's his thinking, but it wouldn't surprise me if it is. All right, the fourth and final thing that I think we can take away, and in some ways maybe this is the most important, Buffett keeps costs to a minimum. He stresses that. He says 90% in a very low-cost S&P 500 index fund. Costs matter. Now, it's interesting. He mentioned VFINX, which is the Vanguard S&P 500 investor share, which I believe is at 17 basis points. Sort of the irony there is if you have at least 10,000 in an S&P 500 fund at Vanguard, you can qualify for what they call their Admiral shares. And that brings the cost down to 5 basis points. So I'm going to guess that he's going to leave his wife more than $10,000. And so he would actually qualify for a slightly different fund that would bring his costs even lower. But here's the thing. You've got, again, the greatest investor of our time worried about costs. He wants to make sure that his investments are again, his words, very low cost. If Warren Buffett wants a very low cost, I would suggest that we want very low cost as well. Again, if you've listened to my podcasts in the past, you know how strongly I feel about costs and how important it is to keep them as low as you can. I shoot to be under 25 basis points, and frankly, I should probably be even more stingy. Costs can just erode returns over a long period of time. You got to keep your costs down. And I think one of the best ways to do that is to invest in low-cost, passively managed index funds. And that's exactly what Warren Buffett is going to recommend for the money he leaves in trust to his wife. I was really thrilled to see Warren Buffett talk about this. This is just very practical stuff. It's very concrete. I mean, he's talking very specifically. This is my plan. This is my asset allocation. These are the funds I'm going to use, or the types of funds I'm going to use. Again, I don't think we should take from this and just say, okay, this is what Warren Buffett said, I'll just go do it blindly. I think that would be a mistake. But I think we can learn a lot from what he shared with us about his own plans laid out in his will. And again, I think what we can learn is he's bullish on stocks. He does have bonds, and he's sticking with short term. He's very bullish on the future of the United States, although, as I said, the S&P 500 does have exposure overseas. And fourth, and I think perhaps most important, very low costs. He wants to keep his costs down, and he's doing that by recommending low-cost, passively managed index funds. So there you go. From the Oracle of Omaha, Mr. Buffett himself, that's how he is going to recommend that the trustee invest the money he is going to leave for his wife. I hope you found this helpful. I think it gives us good insight into how he thinks about investing, and I think it gives us good insight into how we should think about investing. As always, you can shoot me an email if you have questions or comments. I read every single email and I respond to every single email. Just shoot me an email at dr@DoughRoller.net. Again, the show notes for this podcast you'll find at DoughRoller.net/podcast 41. I'll include a link to this article so you can check it out yourself. Again, when you read it, if you have any questions, shoot me an email. And then lastly, I send out a newsletter every Saturday. I mention this on each episode. I link not only to articles that I've published on DoughRoller, I link to articles I've published elsewhere, including at Forbes and Huffington Post and U.S. News. And I also just link to other articles about finance that I find interesting anywhere on the internet. And so I try to make it as useful for everybody as I can. You can sign up for that. It's free. It's very easy to sign up. Just go to DoughRoller.net /newsletter, and that's easy to do. And so there you go. Hope you found this helpful. And remember, until next time, the best thing money can buy is financial freedom.